Bismillahirrahmanirrahim. Assalamu alaikum viewers. You are welcome to my YouTube channel Finance Specialist. Viewers, in this video I will talk about the screening criteria for Sharia compliant stock or shares. Viewers, before starting discussion on my topic, first let me take you through the definition of Sharia. Viewers, when it comes to Sharia, it means Islamic law for which the Quran is the principal source. It contains the rules by which the Muslim world is governed or should govern itself, and forms the basis for relations between man and God, between individuals, whether Muslim or non-Muslim, as well as between a man and things which are part of creation. The Sharia contains the rules by which a Muslim society is organized and governed, and it provides the means to resolve conflicts among individuals and between the individual and the state. There is no dispute among Muslims that the Quran is the basis of the Sharia and that its specific provisions are to be scrupulously observed. The Hadith and Sunnah are complementary sources to the Quran and consist of the sayings of the Prophet Muhammad, peace be upon him, and accounts of his deeds. The Sunnah helps to explain the Quran, but it may not be interpreted or applied in any way which is inconsistent with the Quran. Viewers, as we all know that Islam prohibits any investment or any transaction which is not halal or which leads to interest or riba. So therefore, before making investment in any asset, one should make sure that the investment is Sharia compliant. So investment made in equity stocks is screened in accordance with Sharia principles under the guidelines of the Sharia Supervisory Board are called Sharia compliant equity investments. Islamic equity fund managers use such Sharia equity screening to identify a list of Sharia permissible stocks to invest in while managing a Sharia compliant fund or portfolio of stocks. Viewers, we have 6 criterion. We will discuss them one by one, which are necessary to figure out a company which is Sharia compliant or not. So the first criterion is the business of the investee company. The business of the investee company should be halal. Accordingly, investment in shares of conventional banks, insurance companies, leasing companies, companies dealing in alcohol or tobacco is not permissible because either they are not halal or their main business it involves interest. So therefore these investments are non-Sharia compliant. The second criterion is interest bearing debt. It should be 37% of the total assets. Viewers, for a companies in today's world it is very difficult to avoid interest. So therefore for a company to be a Sharia compliant, the next criterion which it needs to follow is that interest bearing debt it should be 37%, less than 37% of total assets. Interest bearing debt include bonds, term finance certificates, conventional bank loans, finance lease, and preference shares. Total interest bearing debt must be less than 37% of the total assets of the investee company. The third criterion it is about non-Sharia compliant investments, which should be less than 33% of total assets. Non-Sharia compliant investments include investments in conventional mutual funds, conventional money market instruments, bonds, PIBs, Pakistan investment bonds, federal investment bonds, certificate of investment, certificates of deposits, term finance certificates, defense saving certificates, treasury bills, all interest-based placements, and interest-based loans and advances. Non-Sharia compliant investments must be less than 33% of the total assets of the investee company. The fourth criterion is about non-compliant income should be less than 5% of total revenue. Non-compliant income includes bank interest which accumulates at the end of the year if the company or the individual is keeping saving account with the bank, so the bank will credit interest at the end of the year. Income from tobacco and alcohol business, also dividend income from the above mentioned businesses, dividend income from Sharia non-compliant companies, etc. So these all comes under non-compliant income. Capital gain need not be purified. Non-Sharia compliant income must be less than 5% of the total revenue of the investee company. So total revenue includes gross sales plus other operating income. Dividend purification is done by dispersing the amount in charity calculated as per the charity rate determined. The fifth criterion is illiquid assets to total assets. It should be greater than 25%. Viewers, illiquid assets include property, plant and equipment, buildings, furniture and fixture, intangible assets, stock in trade, stores and spares, and all similar assets. Illiquid assets must be at least 25% of the total assets of the investee company. The last criterion is about the market price per share should be greater than net liquid asset per share. Net liquid assets per share equals to total assets minus illiquid assets minus total liabilities divided by the number of shares outstanding of the investee company. Market price per share should be greater than net liquid assets per share. Viewers, these are the 6 criterions which we have discussed. It refers to different countries. The Sharia filtration criteria might have more steps than these steps which I have discussed, but it depends on country to country and the requirements of the Sharia board, and these steps are keep on updated with the passage of time. I hope you would have understood these criterion for your understanding. Thank you for watching this video. You are requested to subscribe to this channel so that in future you will get the intimation of my future videos. Thank you very much. Stay blessed.